Today on the podcast, we have Paul Lemberg. Paul is a business coach. This is pretty interesting. He started off with a fine arts degree, ended up doing some coding, development coding, and then basically moved into consulting for large multinationals, and then eventually started moving to work with entrepreneurs in the world. So he has a framework of how he thinks about progression and improvement in the startup world and kind of the elements that we think about, whether it's increasing revenue or pricing. And so he takes a lot of his expertise in the framework that he has, and then a bunch of examples. And so this is a really interesting conversation. I hope you enjoyed it as much as I did.
Well, welcome, Paul, to the podcast. I appreciate you taking some time to talk with us.
Hey, Todd, thanks for having me.
Yeah, that's great. Well, maybe we can start with just a little bit about your background. So I know you're a business coach. I know you've helped a lot of software companies over the years. And we'll talk about some concrete examples of what you've done in your methodology. But maybe just give me a small snapshot, a couple minutes of kind of your background and how you got to this point.
So how I got here is actually kind of weird. I have a fine arts degree. I went to school and studied photography. And I got out there. I didn't think I was that great an artist, and I didn't want to starve for what I thought wasn't great art. And I said, what am I going to do instead? I went to art school. I wasn't trained to do anything. And I got out. I didn't know what to do. I started a software company. And actually, I went into the software business. I was programming. And I learned a really interesting thing, which is that I had no training in software. I had no training. I had no education. I had basically nothing. And somehow finessed myself a job. And at the time, there were people who had fine arts backgrounds and music backgrounds were considered good for software.
Yeah, it's creative. You have to be creative.
So I leveraged that into a job and walked in and kind of knew what I was doing immediately, which makes no sense. I don't really understand it, I feel like I got gifted that by the powers that be, and it's not something I can really explain. But once I understood what had happened with that, which was that, I can just sort of do anything. And that's really how it worked. So I found myself in the software business. I was working for General Electric and had the impression that they were never going to give me the top job. That was just how I saw it. And I said, well, what am I going to do here? And I ended up starting a software company. That basically, I wrote software that ran some of the world's largest banks. Wow. And we ran that badly. A lot of people sell their companies not out of success, but out of failure. And we had this great software and we had a great customer list, but it was costing us, and everybody should pay attention to this, it was costing us more to get a customer and onboard them than we were making from them.
Oh, that's not good.
We were in that situation where the more customers we had, the faster we were losing money. And people who listen to me say that and think that that's a really strange thing, I think need to really pay attention, because it happens, and I've seen it happen over and over again, where people are losing money on new customers. They're just not they don't know what it's costing them to bring a customer in. And we were doing all sorts of customization on our software for new customers. Okay. And it was costing us a fortune. Wow. And we didn't realize it. We were going out of business and going bankrupt and weren't clear at all. Tried to raise some capital, which you couldn't do. This was in the early 80s, early 1980s. The people weren't investing in tiny software companies at the time. And we ended up shopping around for money and ended up getting bought instead.
Okay.
Which is not a bad thing.
No. Well, that's good. And so then how did you turn that into kind of a consulting practice?
Well, we sold that company. I say we, I had a partner. And the two of us sold that company. And I got fired by the guys who bought me, which is also not unusual. Right. And I got fired. And they, in doing so, ended up breaking my non-compete. So I ended up starting another company in the exact same business. And ultimately sold that one to a large German bank.
Okay.
Worked for the Germans for a while and realized that this wasn't going to be my future. And I ended up getting a job in the consulting arena for giant technology companies. And I learned a ton there. Sold this. Basically, what I was selling was consulting and market research to giant technology companies like Dell Computing, what was then New York Bell, and EDS, and IBM. I could go on for a while.
Yeah.
I did this work. It was, as far as jobs go, it was a great job. I was getting paid a fair amount of money. I was traveling all over the world. I was working with really interesting people, and I was learning a ton. So it was like, as far as jobs go, it was great. But I woke up one day and I realized that the people I was serving weren't really my tribe. And I realized that we could add $100 million to Cisco's bottom line, and the guy who managed that got fired. And I was like, this isn't really how I see it. I can add $1 million to your personal bottom line and it would make a difference.
Sure.
And I wanted to be working with people that my work was really changing their lives. So I went from being a consultant, a large company consultant, to wanting to support entrepreneurs.
Okay, great.
And that's, when I had that idea, it was like this big, aha, and the aha was transformative because, so I have a personal slogan. My slogan is changing the world one entrepreneur at a time. And that's the thing that drives me on a daily basis. Is the work that I'm doing making a difference to somebody, and in terms of their work and their life and their family's life and their community's lives and all the people who work for them, changing their family's lives and their community's life and so on. And that's what I'm driven by.
Well, that's good. And that's that's a huge impact if you can do that, right? The trickle down effect to all those different people. So maybe, it's like I spent a little time prepping for this, and I was looking at your YouTube channel, and basically a lot of the themes, or I think maybe your framework that you came up with that you use pretty consistently is the no strategy. So maybe you could talk a little bit about kind of maybe some of the premise and some of the framework of that. Because I think it's kind of interesting, and I think it really does fit to a lot of startups, this kind of iterative tinkering type of mentality that you have an approach.
It's really very simple, Todd, which is that the idea is that there are things in businesses that give you tremendous leverage. And I'll give you like a tiny example is what is the long-term value of a customer? And if we can improve the long-term value of a customer, we can transform the entire business. And to do that is not it's not like a big swing and something that you can really mess up. You can't mess this up. So you improve the long-term value of a customer by selling them more things, and selling them more things at a higher price, and selling them things that fit with what they've already got. So whether they're upsells and cross-sells, and we can look at that particular thing as a small, tiny change. And what's our strategy? Our strategy is we're going to improve customer value, right? I mean, that's really pretty straightforward.
You think so?
There's
Yeah.
there's a handful of things inside of I'll say every software business, but it's truly every entrepreneurial business, and they cover every business. So the idea behind the no strategy is there is a strategy, but it's super simple. And the strategy is making small changes that relate to each other.
Okay.
And we can make tremendous changes to a business. So I have a product called Formula 5 that instantiates this. It's all about this idea. Mm-hmm. And people create 2x gains in their business, 2 times gains, and they can gain 4 times gains because you can do it again, and they can gain 8 times gains and so on. Like, I don't know how to improve a business by 10x.
Yeah.
How are we going to 10x a business reliably? The way I do it is I say, let's figure out how to double it, and then we double it, we double it, we double it again, and then we grow it a tiny bit more, and it's gone up 10x.
Yep.
And it's foolproof.
And maybe what you're saying, though, is it's a series of incremental pivots based on kind of the data you have, right? Whereas, like thinking about like a 10x, they're looking for, hey, just launch this new product or change one thing and we're going to get this 10x return, which is high risk, high reward. And what you're saying is it's almost like Bayesian theory, right? Where it's like, I have a set of hypotheses, I'm going to take a change. And then basically as I get more data, I'll make another pivot. As I get more data, I'll pivot and then basically continue to a point where I've 10x my business.
And exactly. And each of these pivots are small. And you said it a moment ago, you said high risk, high reward. What I'm getting people to work for is high reward, low risk.
Low risk. Yep.
Low risk. So each of these changes, and the thing about these changes is they compound on top of each other. If I was just doing a little bit of arithmetic and I figured out that if we had 5 things that each related to each other, so that something in increasing long-term customer value and increasing the number of new customers, those 2 things relate to each other. So what we do is we look for things which relate to each other and gain small incremental changes, call it 15% in each of these 5 areas. And 15% in each of 5 areas gives you double.
Right.
And it's just,
Paul,
this is just arithmetic.
Do you think we work with a lot of startups too, and I guess sometimes the level of maturity for the data that's real to get to what the incremental changes are going to be is difficult, right? And so, we look at finance as a starting point where, a lot of times a company that maybe is doing $1 million, $2 million, maybe the maturity of their reporting on financials aren't great. And so figuring out even a CAC value, customer acquisition cost, or lifetime value, maybe they have some barometers to it, but usually it's not as specific as you want. Do you feel like you have to go back in to make sure that foundational data is good to identify where those pivots and opportunities are?
Every single time.
Yeah.
Yeah, you said it well, and you said it very nicely. But firstly, if I walk into a new customer and I say, what are your gross margins across the board? They can't tell me.
What?
They simply don't know, right? Yeah. And if I say, what's the average value of a customer over time? And they simply don't know. And they basically don't know any of those things, which is why, and you summarized it in my list of what things do you look at first. And the first thing you look at is to start to normalize your data.
Okay.
And understand your metrics and figure out what things that you're actually going to look at. And I just threw out a couple of them casually, which are like, what's your average gross margin? And what's your average net margin? I'll tell you a really interesting thing about net margin, which is that if we figure out that we have a 10% net margin, and that's kind of the average across all American businesses, if we have a 10% net margin and we raise prices by 10%, we've just doubled the profits.
Right.
And
right.
I tell people this in a crowded room, and everybody goes, how can that be true? How can that be true? And it's really simple, and I'll give you just the tiniest example, which is if we're selling something for $100 and we have 10% margin, means that we're keeping $10. And if we raise the price by 10%, so it's now $110, the costs are still $90, they haven't changed, and our profit has gone up to $20 from $10. What's that? Oh, that's double. Right. And the math works out every single time. If we raise prices by the net margin, we double profits.
Yeah.
And that's not a hard thing to do.
Well, I guess I've been in a bunch of businesses, and I'm sure this is kind of tracks with yours, right? So at the very beginning, when you don't have a lot of customers, your price, you're discounting hard. You're below your competitors. You don't have all the features, and so you go kind of through this continuum of like, I'm super cheap to I'm getting to like list price without discounting, and now I just want to make sure that I don't churn these customers, right? Because I feel like if I basically do either net new, and basically it'll slow down my sales cycle, or if I apply it to the base, then basically my churn rate's gonna go up. So and I think when you talk to entrepreneurs, you got to figure out how sticky that thing is before you actually do some of that. But I'm curious on some of the things, like, is that a trajectory that you see with a lot of customers? Because even the company I worked at, Concur, we raised the rates. We were always the most most expensive in the market.
Right.
And there wasn't, and it was just a hard tool to get out of once you got in, and it was part of your workflow and it touched all these different, parts of the organization. You didn't want to rip that thing out. And so there was price elasticity that we could actually do, and basically, but then you see some other ones where, especially in the SMB space, if you're working in the SMB space, there's a lot more price sensitivity. And if it's an easy product to swap out with a competitor, you have to be careful on the pricing.
Yes, you absolutely do have to be careful. You can't do this sort of willy-nilly, but you can do it. And there's a number of different ways to justify your price hike, which is basically you're adding features or you're adding some kind of service level or you're adding something to it. But did you find that when you raised prices that your closing ratio went down?
Generally, no, but it's like everybody says it up front, right? They get all freaked out that like basically either the sales cycle is going to elongate or I'm going to lose some deals because of it. And then basically when you do it, it's usually not bad. Like nobody really bats an eye. And so, but it is hard to get startups to like continue to increase their price. One of the things that I found that actually works pretty well is put in your contract just a CPI increase, because then it's not a question, right? Legally, when they sign their contract, your consumer price index, if that goes up 2-3 points, then you're getting that increase every single year. And so in that one, it seems like if they negotiate it up front, they don't even bat an eye. And even if you don't do the price increases, you're getting it through and at least keeping up with inflation.
That's a brilliant idea that I've never, ever considered, and I like it.
You can steal it. It's all yours.
Put that in my tool bag right away. I've learned something today, so that's great. Thank you, Todd. Here's what I find. I have been a salesman most of my career. From maybe into 2 years into my career, I became a salesman. I turned away from, I didn't want to sit in front of a computer screen all day long, and I'd rather be out with people. What I find is that salespeople, and you know this, that salespeople who are concerned about price are usually bad salespeople. And what they don't know how to do is figure out what the ROI on an investment is. And the ROI on an investment doesn't change that radically if we raise the prices. We just have to do the math and let them. One of the things that I do, this is really a useful tip for people who are selling anything, is that I never tell the prospect what something is worth. I outline how we get to where it's worth something and then ask the prospect what they think it's worth. So if we say, we're going to sell them a tool and it's going to make it easier for them to close customers. So I don't tell them, well, with this tool, you're going to be able to close 25% more customers. I say, with this tool, do you think you'll be able to close more customers? And they say, yes. And I say, well, how many more do you think you'll be able to close? And they say, I have no freaking idea. And which is legitimate, because how would they have any idea? But you ask them to guess. And the whole point is to get some numbers on the table. And if they just guess and they go, gee, I don't know. And I'm like, well, guess. And they guess at something, and that something becomes truth. Whereas if I guessed at it, it's just me trying to sell them something. Whereas if they guess at it, it's truth. If it comes out of their mouth, it's truth. So I walk them through the entire calculation process, asking them at each step what that's going to be worth to them. And they've just outlined what this thing is worth, and we compare that to the newly raised price. We just have to go through what are the elements that go into figuring the valuation and let them think about each one of those. And we walk through the whole process. And if we have a positive ROI, they can't complain about the price. This is kind of my thinking, that raised prices almost never cut down sales ability. They only cut down sales ability from bad salespeople. So it's really worth it. If your salespeople push back on you and they say like, oh, we can't do that, we'll lose sales, then we just need to figure out how they go about their sales process, because we can work around that.
Yeah, I mean, I think there's a natural tendency, or there's a natural tension, right? They have they've got a goal that they're trying to get to, an OTE they're trying to get to, and if you're doing anything that makes more resistance to it, they're going to push back, right? Like, I've been around sales most of my career as well, and so, like I think just in general, just on principle, they're going to say you're making my job harder. I don't want to do it, right? And so I'm going to scare you and saying I'm not going to be able to deliver those numbers I promised you, and so, but I do think, so taking some of this that I think is really good, I think there's maybe an element to what you're saying about ROI driven, which is really value driven selling, really is what you're talking about. And so what you're trying to do, and what we kind of preach a lot is there's a lot of work on the discovery side to draw out what the pain is. Like, what problem are you really trying to solve? And then quantify it, right? Like quantify, like if you can't close these sales ones, what's that mean to you? Like, is it way more effort and your conversion isn't right versus the product that we're talking about, like your example saying I would close X amount more, then they basically self-serve to solve the problem that they already said they have. And basically they're already down the road of saying, I don't really care what it is. That's important to me to go solve. And so I do think that a lot of times entrepreneurs in particular sell features and not value. And I think one of the key things that you're talking about is sell on an ROI, sell on a value, but you can't sell on value until you understand completely what their problem is.
I sell my coaching services range in price from about $80,000 to $100,000 on an annual basis. I have to sell that based on value because by no ordinary metric, if we try to figure out dollars per hour, it's a really hefty number. And you can't sell on that metric, but if I sell on, well, what do you expect to get out of this relationship? And what do you think it's going to impact your bottom line? And call it that $100,000. If we drop an additional $1 million into their bottom line, and I'm always going for that. And if you have an additional $1 million coming into your bottom line and it costs you $100,000 of advice, that was a pretty good deal. Especially when we get to that $1 million, we say, well, how many years do you think that's going to work for? And they have some big number and we multiply it by that. And
that's exactly where I was going was.
Cheap.
Yeah, that's where I was going was I think the multiple in these SaaS businesses where, on the low end, it's 5 or 6 and on the high end, it's 10 to 12 to 14. And so I think your talk track is right. If I can help you, add 30% to the enterprise value of your company for $100,000, that's up to you, right? It seems like a decent ROI if I can help you get there. But
the ROI is tremendous. I once had a customer's partner. So my client, the guy who I was working with, who was the CEO, and he had a partner who was a semi-silent partner who was putting in money into the business. And the guy wanted to know why I was charging them so much money. And he was sort of shocked by the whole thing, and he had figured out what the dollars per hour was, and he was sort of shocked. And I said to him, well, what do you think is going to happen in your business if we're successful doing all the things I promised you? And he just looked at me and he says, oh, I get it. And that was it. That was the end of the whole conversation. It's like, let's think about value instead of comparing it to what a lawyer charges you or what an accountant charges you or something like that. And it's like, and I always ask the question, it's like, how much extra money does your lawyer earn you?
Right.
And they stop talking. Right?
Yeah, exactly. Moving on. Right. So maybe talk to me. Go ahead.
Yeah.
Pardon? Say again?
So you being who's ever listening, you can apply this thinking to whatever you're selling, and all costs are elastic if you're looking at the actual value that's being provided.
Yeah, and maybe I'd drill a little bit, like this is more of a pet peeve of mine, is I think that entrepreneurs and early salespeople go to demos way too fast. I think you got to hold that sucker back, right? You got to mine and understand what their current process is, what competitors they're using, where are they having deltas, and then you start to do enough discovery where then you can build kind of a custom demo to meet their needs and say, and you do all the anchoring, right? It's saying, here's what I heard from you, the problems. And if our solution could solve those problems, that's valuable too. Yes, get them to anchor. Then you go through the product and say, this is the scenario you said. Does it solve your problem? Yes. And then you get them to get to a contract. And so it's 101, but I think so many times they're so proud of the features they built. And it's the conception of the problem that they see, not the customer. It's their idea of what their problem should be.
That's very well put. And, when I was selling banking software, our demos took 3 weeks. And that's why that sort of underlines why we were going bankrupt for each sale. The cost was tremendous. And I wish I'd known what I know now then, because I would do it just exactly the way you described it. We didn't know that then. We thought our features were so exciting, and we wanted to sell them all these features instead of going through the inquiries like, what would transform your bank?
So maybe, Paul, I guess the next piece, you and I have some parallels in this, right? I don't have your framework, but I have a lot of similar pieces to this. And so maybe I'll just keep hitting on things that I have problems with after you tell them. So identifying problems in a startup is not hard, right? There's a lot of them. And then finding the number one that'll move the needle, takes work, but it's not rocket science. The next question is, how do you align the organization to actually go do it and execute and get the benefit of it, right? And so a lot of times you got smart people that are saying, Todd, I totally get what you're saying. That totally makes sense. But then the operational challenges of actually doing it are not trivial. And they don't have a lot of resources, right? And there's priorities that are conflicting. And so I'm just curious, as you talk with entrepreneurs and you come up with these kind of pivotal ideas that are moving the needle incrementally, how do you create an environment of execution that basically creates accountability for the recommendations that you make?
So the simple answer is I only work with the chief executives. I don't work with anybody who's not in the chief executive role. And the reason is because they can't make decisions that impose them on the company. So I think the key value of coaching is not necessarily the information that gets provided, but the key value of coaching is somebody who can come along who has the sufficient experience to browbeat a CEO into taking action. You couldn't do that if you were a newbie, but I come in and I have so much experience that I can talk the CEO into taking action. But that's a lot of where the value is.
So I think you're totally dead on, and I do the same thing. I think there's more usually a forcing function, right? Either somebody like an investor's pissed off because of performance, you're running out of money. There's a clarity lens that's looming that basically people are like, I need to solve this problem now, and so then there's clarity and focus. I think sometimes when you are coaching and you're telling them and things are going okay, it's just harder to get across. You need to. There's bad days coming, and you need to tighten up all this stuff. You're kind of fat. Your percentage of revenue versus the number of employees you have is kind of out of line for your industry. So I'm just curious if that resonates with you, or if you have different experiences.
So it's usually not. It's what you said. You called it a forcing function, which is a very interesting way to put it. And what I find is that the way I get people set up. So we start with a deep dive into their business. So we lay out what's going to be the implementation strategy, which is fairly short term. I look at it across a couple, 3 months and not much longer than that, because I find that, what did they say? No battle plan survives first contact with the enemy, right? Yep. And any long-term strategic plan is bound to fail. Yep. So I get in there. The other thing is that the fact that they're paying a lot of money is a point of leverage. You're paying me 6 figures here. Don't you think you ought to listen to my advice? Yeah. Right? And that really counts. I have a great example of something that happened, whereas these guys were a consulting firm for hospitals. They helped the emergency room teams and the surgical teams communicate better so that patients didn't die. The whole thing where they write on your arm and say, it's this arm, and then they write, it's not this arm. Not this arm. Right? Like that, the not this arm was their invention. And the idea of writing on people, this comes from how cockpit crews communicate. And that's what they call it. They call it crew resource management. So these guys had this thing that people wanted that did the job. Testimonials were rough from them because nobody wants to say, oh, we were killing this many people and now we're killing this few. So they didn't want to do that. Right? So I was trying to teach them how to sell, because you had to make the sale with the chief of medicine. You can't get like a doctor who's going to come in, you're going to sell it to the doctor and he's going to bring it in. It had to be sold to the chief of medicine, but they couldn't get access to this guy. So I have a process for doing it that I got from a sales trainer named David Sandler, which he calls Wimp Junction. And Wimp Junction is a brilliant place to be. So I'm teaching this guy, who's the CEO, and this guy when I met him, he put his cowboy boots up on his desk. And he said, at one time, I was the top pilot in the U.S. Navy. And I was like, wow, that's impressive, And it turns out this guy was a Top Gun instructor. So he's like way, way up there. So I'm trying to get him to go to Wimp Junction, and he's kind of wimping out, and he's not doing it. This goes on for a year. And every day I'm hammering him about, did you go to Wimp Junction? He's like, no, we didn't make the sale. He finally started doing it, and it all of a sudden rocketed the closing of these deals. And deals went from taking weeks and weeks to close to a week. So we really did this tremendous change in the business. So I finally got him after the course of better part of a year to do this, to change the way they were selling. And I also had them doing a PR program, and this was pure luck. We landed on the front page of the Wall Street Journal. In that little section, right? We landed in there. So between landing in there and changing the way he was closing, the way he was selling, we got an 8x jump that year. We went from $1 million a year of profits to $8 million a year, and it was really like unbelievable. So I lean on that all the time, which is that I know that there's pushback, and I don't really care about the pushback. I just keep pushing against the pushback. So when you ask how do I do that, it's really just force of will. It's my personality and force of will. And I'm convinced that who's ever running the show has got to do what I'm telling them to do. They just have to. And when they finally do, we get tremendous results.
Sure. Yeah, that's good. So what other scenarios have you seen? Like customer retention, churn rates. Like, how does your model kind of apply to some of that? Because I think I see startups that basically focus on sales and they get better at it, and that's kind of a drug. It's like I get better and better, but then they forget about their existing customer, or they say, I'll just let support deal with it, right? And so they don't really take the customer through a customer journey, which is, my experience in year 1 versus year 3, year 5. I should be getting different value out of your product over time. And a lot of times I think they're slow to kind of implement some of that. And that can increase attrition at times. And so I'm curious is that a problem that you've seen, and what sort of coaching do you do around some of those topics?
So one of the we mentioned it right in the beginning of this conversation, that long-term value of a customer. And one of the key components of long-term value is how long do they keep spending money with you? Yeah. Right? And that's true whether it's a SaaS company or whether it's I don't know what the opposite of a SaaS company is. What do we call that? Like
brick and mortar. Probably brick and mortar. Yeah.
Brick and mortar. I mean, I know a lot about what it's like to ship updates. And SaaS is like such a better model for the owners of the company. But retention is one of the key values, one of the key metrics that we have to track. And just like everything else, in the no strategy model is we turn our attention to the next piece of the business that we're going to work on. So if we're going to work on pricing, we're going to work on margins, we're going to work on the long-term customer value, we're going to learn, these are the kinds of things that we're going to work on. We're going to work on product mix and so on. And so one of the things that we're going to work on is customer retention. So we start to do a deep dive around that and find out what most companies aren't doing is they're not finding out why you left. They have some cursory little survey that doesn't really give many information, and we make it in such a way that it doesn't get filled out well. So we have no idea why customers are leaving. Whereas if we do a deep dive, I'm a big fan of oh, talk to the customer, right? Right? Like no matter what, the client says to me, oh, we have a problem with X, Y, Z. And I say, well, what's the problem and what's causing it? And they go, I don't know. And I have you talk to a customer, right? Right, like why are they leaving? I had a client who we were talking about implementing some changes. I don't remember what they were, and he said to me he didn't really understand if they would work. And I said, what's the size of your customers? His customers were retailers, and I said, what's their typical turnover? And he says, I don't know. I said, well, how could you not know? He says, how would I know that? I said, well, I would ask them what their revenue was. He says, you can ask them what their revenue is? I said, you're going to sell them software that runs their business. Do you think you could ask them nosy questions? And to me, it was the funniest thing. It's like he just didn't even conceive of being able to ask the customer what their revenue was.
Right.
So, the customer leaves. It's like, we want to know why are they leaving and what could we do to get them to stay? If we do that, we go through that cycle, why are you leaving? What could we get you to stay, and so on. We do that enough times, we start to develop a lot of information.
Yep. You're starting to see patterns, and then you can figure out ways to triage and fix it.
It's really shocking, the idea of not asking the customer everything that you need to know is kind of shocking to me. So when I look at what people don't do and why they're not doing it, you asked about accountability, getting them to execute. It all boils down to, all right, what are the things we have to do to make this work? And what are the steps? And get them to be in the steps. And it's like you said, it's like, they don't execute. It's like, well, do you think there's a reason that you should be executing, right? Yeah. What are we trying to do here?
I think that your point's well taken, especially on the customer side. I think that early on, when you're building your first product and you're out selling, especially the founders, I think they tend to know their customer pretty well. They've done some customer discovery. They're building an MVP, and then they're iterating on it. As the company starts to scale, I do think they drift away a little bit, right? Or they basically assume the problems and the way that the customer used it when I first started is exactly the same as when I'm in kind of mid-career of my company, right? And it's like, no, that's changing. Right. The industry's changing. The competitors are changing. And your ability to get back to knowing the customer, I think, is a key theme all the way through that success.
I wrote a piece, 2-3 months ago. I wrote a piece that was all about that you have to grow, right? You have to, there's no reason, there's no argument that you have about that you don't want to grow that makes sense. And you just said it. It's, if you're not growing, it's a good bet that your competitors are. It's a good bet that your customers are growing, your competitors are growing, the people on your team want to grow. There's all sorts of reasons. The world is changing, technology is shifting, the municipalities that you're working in are changing, they're all changing. And if you're not oriented towards growing with those people's growth, you're going to fail.
Yeah, I totally agree. I think that's a really good point. So maybe, I think we've talked about some of the elements of your no strategy. Maybe now it's time to talk a little bit about maybe some of the use cases or some of the examples that you've done and you've worked with to kind of talk about how you implemented it. And then, was this a total kind of running through all of these elements? Did you use some of them? And maybe give me a use case of one that you've applied this to that was a software company that had some success and maybe the problems and then the outcomes.
I had people who were doing this, they had written software that was kind of a psych evaluation. And the way they were selling it was primarily through one affiliate, one strategic partner. And my attitude was, what are we going to do for lead generation? We're just going to take what we're doing and grow each of those things. So I said to this team, it was a husband and wife team, and I said to them, they were like, how are we going to grow? They said, we have all of our sales come from one perfect strategic partner. And I said, okay, that's incredibly dangerous.
Yes. And
there's no obvious way to grow that strategic partner. I said, so the solution is let's get another one. Let's get 2 more of those. Yeah. And they looked at me like I had 3 heads, and they went out and they went out and found, so I had them to be able to come back with somebody who was like those. I had them map out the key distinguishers for that particular company who was their strategic partner. So
Sure.
what were the distinguishers? And they used that to look into the community and find a couple of other people who would relate to, who would be able to do the same kind of thing, who would get the same strategic value out of the partnership. So they actually found 2 more of those and brought them in. And when I spoke to them like 6 weeks later, they had a 3x jump in revenue.
Yeah.
On a run rate basis. And that's just the simplest thing in the world. It's like, let's find more. Because everybody says, oh, we're using strategic partners. How can I double those? It's like, you find another one, duh. And they 3x their business. So they were actually they were happy.
Why do you think they didn't come up with that themselves, right? It seems super apparent. And they're smart people running their business. They understand the industry. What's the resistance to doing that? Do you feel like they felt some loyalty to the first strategic partner? Again, it's not rocket science. And I know like an objective person coming in with fresh eyes certainly helps. But how do you get founders to kind of not overlook the most obvious things in their business?
Well, they overlook them. That's why they need to hire people like me, because they do overlook them. Right? And long ago, I have stopped asking why they overlook these things. With the fighter pilot I was talking about, this guy's entire company, the entire management of this company, were composed of doctors, flight surgeons, fighter pilots, astronauts. None of these people were slackers. All of these people were very smart, very motivated, very aggressive people, and they just didn't see things. I walked in the door there, and they were convinced that each new customer was costing them more than they were getting in revenue. And I had looked at the books, and I said, this is absolutely not happening. And they were sure, and their accountant was sure that this was true. What actually had happened was the company was split in half, and half the company was selling to the government, and it was all cost plus. And the other half was selling to hospitals, and that was like doing normal business. What happened was, because they were doing the cost plus, they applied that to the entire company, and what they were doing was overstating their overhead. And the overstated overhead was actually causing it to look like they were losing money. But they couldn't figure this out. I had to figure it out by studying the books. So I'm not an accountant. I went to business school and I studied some accounting in business school. And accounting's pretty easy. The laws are complicated, but the actual arithmetic is pretty simple.
Right.
So I look at it and I go why didn't the accountant see this thing? And the answer is because he wasn't looking for it. And I think that the question is, why don't people see what's obvious to them, where they can make those changes? And I have no idea. Because none of the people I deal with are anything but very smart. They're all very smart. They're all seasoned. They've all been doing what they're doing for years, and they overlook the most obvious things. My job is to come in and see those obvious things. That is what I do. I'm good at studying stuff, and that's, you say people can never see their own bald spot. It's like, why can't you see it? Because you're not standing behind you. But I walk around the back part and I say, oh, did you notice that thing right there?
You're like, Paul, you didn't need to tell me that. Thank you. How about another one? In your notes here, you had one on kind of hospital records. Is that one we've talked about already, or is that a different one?
No.
Okay.
American Health Tech, they weren't growing and they weren't making money on their revenue. And it was just one of the things that we did was increase prices, and we increased their product offering. So this is counterintuitive. People don't realize this. It's not counterintuitive, but they don't realize it. But one of the things that happens when you have more products is you have a greater opportunity to make sales to the same people. Because you try to sell them one thing and they don't buy it, and you try to sell them something else and they don't buy that, and you try to sell them the third thing and they do buy that, and all of a sudden we have more opportunities to make sales. So I increased the offering, and we stratified the offering in terms of adding a high end to it and adding a low end to it. So one of the things about pricing is the more price points that you have, the easier it is to make sales to your market, to whoever the collective people in your market is. So we stratified, we created more of a pyramid to the product mix. So we had some low-end things and we had some high-end things. We increased prices overall, and we improved their sales force. And that was a huge shift, was improving their sales force, because they didn't have much of a sales force. We added more salespeople, and I taught them how to run their sales force. One of my products is all about how to build a sales force from scratch. It's for software companies. If you have a typical product price of $5,000 or more, then you can always have a sales force cold calling, and you can make it up without actually paying them. You pay them strictly on results. So I built an information product that shows you how to do that from soup to nuts, and that served a lot. So I helped them build their sales force and improve their sales force. Plus, they had a leadership problem. They had a problem where most of the people who were part of this company came from the medical industry. Those people tend to be underpaid. So whenever I lean into okay, we're going to do more of this, then we're going to add numbers here, and they all, they're not the kind of decision makers that you want doing this. So I had to rewire all of their thinking, and I took them through a deep dive of their own company and had them show them things about their own company that they just weren't aware of. That gave me a lot of leverage to help change how they were operating the business.
Sure, I can imagine.
And so there's I started to do this last night, and I shouldn't even say this out loud. It's like, I can't remember what half the things we did with half the companies are, because I have no cookie cutters. I have frameworks that I use, and I have a lot of things that do work, but I don't come into a client with a cookie cutter. I understand, well, we did it like this in some other company that was like yours, we're going to do it like this. That never works. So this is very bespoke. So that's why I can't remember from one to the other. It's like, what did we do with those guys?
But don't you think there's some patterns that repeat? I mean, maybe not the nuances, but the patterns kind of repeat. And I see this all the time. We only deal with SaaS companies, and the industries that we work with are so diverse. But even if I don't know the domain expertise, you can usually see a pattern and say, there's a place to go poke here. And yes, there's a lot of context that's specific to their company, but I think 80% of it gives you the direction. It's like, here's the north arrow to go find it.
That's really true. And when I look at the no strategy, which comes from this product I have called Formula 5, that there's in the product itself, there's something like 400 different buttons to push, sorted into 5 main areas. So I use that as the navigational star.
Right.
I just look at it and say, so if I know that long-term customer value is an issue, and if I know that stick rate is an issue, I say, well, what's your stick rate? And they never know. They never know how long customers stay. But the cool part is we go to the CRM and we can pull that out really easily. Yep. And I sort of surprise people. I said, let's sit down and look at your CRM and get the real data. And they're telling me, the stick rate is like 7 months. And I'm going it's not. I'm telling you it's 3 months. And they're like, how do you know that? I said, because I'm just dealing with averages. Yep. So the average is 3 months. And then you go to the CRM and you start counting. And we get a real number. One of the things that I like to do is if I figure out what the stick is, then I end up taking whatever the monthly price is and multiplying it by the stick, and then giving people a lifetime value. Lifetime, you can get this thing forever based on the number, the months of stick times whatever the monthly is. And we give it to them as a lifetime, and they look at that and they go, well, we'll lose money. I go, you won't lose money. It'll be the exact same amount of money you're getting now, except you're going to make a lot more sales.
Right. Yep. Totally with you.
So it's not like I didn't know. I just knew to look there.
Right.
That's really what it is. It's all about looking at where all these key points of leverage are and looking at what the data is surrounding those key points of leverage. So if we say that the key point of leverage is that we're going to get how much time somebody is effective at working. One of the things, I did this based on research that I found out. We did a survey of about 500 small company CEOs. And since then, I've been talking to audiences ever since. And that's probably about 15 years ago. And what I figured out was that on average, that your typical CEO works about 2.5 hours on what I call A work. You know, A work is work that creates value for the company, financial value for the company. B work is work that supports the A work. And C work is everything else.
Answering your email, going to meetings.
Yeah, it's just everything else. You know, it's all sorts of things. I ask audiences what their, what's their secret thing that they love to do that they know they shouldn't do? What's their guilty pleasure? And I had a guy once raise his hand and say, I like ordering supplies. And I was like, oh, man. So it's 2.5 hours. And it's on average, if I'm in a room and I ask them, every single time the average comes out to 2.5 hours, no matter how many people I ask. And it's 2.5 hours, irrespective of how much time you work throughout the day. You have a 10-hour day, you get 2.5 hours. You get a 6-hour day, you get 2.5 hours. And that's just how it works out. So I figured out that if we got a 15% increase in A work, and turned it from 2.5 hours into like 2 hours and 45 minutes. Right? That extra 15% gives them the extra, or that extra 15 minutes gives them the 15% jump. And if we get everybody to do that, which is really pretty easy, that it's transformative.
It's a huge compounding in the company. So Paul, kind of wrapping things up, we're getting close to the top of the hour here. Like, if you had to pick 3 things that basically out of your experience that you would say for a founder to kind of really think about, what would those 3 things be?
Do you mean think about quickly or think about long term?
Yeah, I mean, I think they do enough quickly things. I think it's more the long-term things, right? I think it's like, I think there's always, like I always call it the fog of war, right? There's always things coming at you all the time. And I think where entrepreneurs in general and founders, as they scale, they forget to block some time to really think about working in the business or on the business and really moving it forward. And so and I think a lot of what you're doing is really trying to set the company up for longevity and scale, right? You want to continue to grow. And so what would the 3 things be that you think entrepreneurs should really think through in their own business?
So if I'm talking about a SaaS business, then the first thing I want to know is what's the monthly revenue? That's really important. And we can improve that in large part. We can improve revenue by improving the price. And we can improve revenue by looking at the number of things that they can buy throughout the course of a month. What's the upsell? People look at upsells. One of the things I get people to think about is people look at upsells as being pushy salespeople. And the definition that I have as an upsell is getting the customer more of what they really wanted when they come to make a purchase rather than cheaping out. And so if we get them to think about upsells and cross-sells, so what else can we sell this customer that's going to give them more of what they were really looking for? Too many people think about how do we make more money, and what they don't think about is how do we create more value for the customer, which in turn gives us more money.
Makes more money. Yep, totally agree.
But once you frame it that way, it gives you a whole different way of thinking about your relationship to your customers. I think it's very powerful. So if we look at what's the average customer value in a month, and how do we improve that, and including that both in terms of having different products to sell them and to have different higher price points. So that's one thing. The next thing is, again, for SaaS companies, super, super powerful is how do we improve stick rate? right? Not stick rate, but stick time. How do we improve the time that they're going to remain a customer? And doing a deep dive into that, which is, we talked about this earlier, is why do people leave? And then redressing that and doing something about that. And if I'm a SaaS company and I improve what my average monthly is, which has an immediate effect on MRR, right? So we're going to improve MRR by improving what the average monthly is, and then we're going to improve the value of the customer by enhancing stick and how long they're going to stay for. And then we're going to improve how do we get new customers, which they don't, especially if the CEO is not a salesperson, they shy away from this. A lot of CEOs don't feel like they can manage the sales team very well, and because they're not salespeople. If they're salespeople, then they know they can manage the sales team. And the idea of improving the close ratio, we spoke before about closing based on value. If you're not closing based on value, then the transition to closing based on value is going to transform the close ratio.
Yep.
So we want to improve the close ratio. We want to improve lead gen. And if we work on those four things, and then the fifth thing is simply the amount of time available that the CEO has to work on a work.
Yeah. Well, it's good. Well, Paul, I think that's been super helpful today. And so it's been awesome you sharing your experiences and talking a little bit about your framework. If people want to get a hold of you, what's the best way to do that?
Simplest way to do is letter P for Paul at Lemberg.com. And Lemberg is the same spelling as my name on it's right at the bottom left where my name is. So it's P@Lemberg.com.
Okay.
It's my personal email address. And they can also go to www.lemberg.com, which is my website, and just go to contacts and drop me a note in the contacts.
Okay. Well, sounds good. Well, thank you very much for spending some time with us and sharing your experiences. I think it's been really fun, and I think there's lots of nuggets here. So thank you very much.
Terrific, Todd. Thank you for having me, and you're totally welcome.
Okay. If you enjoyed the podcast today, please just take a moment to rate it or comment on it for us. This feedback really helps us, and it helps us get the word out to helping other entrepreneurs and founders. Thank you.